Hey there, future CMAs, welcome. So, you've battled through assets, you've wrestled with liabilities. Now it's time to conquer that final, crucial piece of the balance sheet puzzle, equity. This is all about the owner's slice of the pie, and trust me, knowing these transactions inside and out is absolutely make or break for your exam. You ready? Let's get into it.
Here's our roadmap for today. First, we'll nail down what equity actually is. Then, we'll walk through the big three transactions you'll face on the exam: issuing stock, buying it back, and paying out dividends. And we'll wrap it all up by hammering home the one core principle that's going to be your secret weapon for any equity question they throw at you.
All right, let's kick things off with the fundamentals in Section 1. When we talk about equity, or the owner's slice, what are we really talking about? Well, it's simply what's left over for the owners of the company after every single debt has been paid off.
So, the official definition here calls it the residual interest. That's a key phrase you gotta know. It literally means if a company were to sell off all its assets and pay all its liabilities tomorrow, the cash left in the pile is the equity. And this is a huge distinction for your exam. We're talking about the book value here, not the stock market price that's bouncing around every second.
Okay, and here it is. This is the big one. If you walk away with just one thing today, I want it to be this golden rule. Seriously, burn this into your brain for exam day. A company cannot, I repeat, cannot record a profit or a loss on its income statement just by buying and selling its own stock. Keep this rule in your back pocket. I promise you, it will make so many complicated questions incredibly simple.
All right, now that we have our golden rule, let's actually put it into practice. First up, what happens when a company issues new shares of stock to raise some capital? So when a company gets cash for its stock, the accounting rules say we have to split that money into two buckets. The first is for par value. This is just a tiny, legally required amount, often just a penny a share. The real money, pretty much all of it, goes into the second bucket, additional paid-in capital, or APIC. And notice what's not happening. That extra cash isn't profit. It's just more capital from the owners. And here's how that journal entry actually looks. It's super straightforward. Step 1, you debit cash for all the money that came in. Step 2, you credit the common stock account, but just for that tiny par value piece. And finally, step 3, everything else, the rest of the cash, gets credited to APIC. See a pattern here? Something missing? Yeah, there's no income statement account anywhere in sight. It's all happening on the balance sheet.
Okay, so here's a classic exam curveball. What if you issue stock not for cash, but for something like a building? How do you value that? Well, the rule is pretty logical. You just record the whole thing using the fair market value of whichever side is easier to figure out. The stock you gave away, or the asset you got in return.
Okay, let's flip the script. What happens when a company goes out and buys its own stock back from the market? This creates something called treasury stock. And remember this name, it's a contra equity account, which is really just a fancy way of saying it reduces your total equity. It has a normal debit balance, unlike most other equity accounts.
Now, for the exam, you got to know two ways to handle this. The cost method is the one you're going to see 99% of the time. It's simple. You just record the treasury stock at whatever price you paid to buy it back. The par value method is the other one. It's less common, but they could ask about it. It basically treats the buyback as if you're retiring the shares for good. Focus on the cost method, but be able to recognize the other one.
And boom, here's our golden rules showing up again, and this is a big one. If that company later resells the treasury stock for more than it paid, that gain does not go to the income statement. Nope, it goes to APIC. If they sell it for a loss, that reduces APIC. The entire transaction is quarantined inside the equity section. I'm telling you, this is one of the biggest traps on the exam. They want you to put it on the income statement. Don't fall for it.
All right, moving on to the part everyone likes, getting paid. We're talking about dividends. But for us, for the CMA exam, the most important part is the timing. The journal entries are all about hitting the right dates. So let's break down the timeline. So check this out. There are 3 key dates, but only 2 of them actually matter for our journal entries. First is the date of declaration. The moment the board says we're paying a dividend, bam, you have to record a liability. Next is the date of record. Listen close. No journal entry here. None. All this is the day they make a list of who gets a check. And finally, the date of payment. That's when the cash actually goes out the door and we clear out that liability.
Okay, another exam favorite coming up, stock dividends. The accounting rule here is kind of weird, but it's simple, and it's all about size.
If it's a small stock dividend, less than about 20 to 25%, you record it at the stock's fair market value. But if it's a large one, you record it at that tiny little par value. Is there some deep, profound reason for this? Not really. It's just one of those US GAAP rules you have to lock into your memory for the exam.
Okay, deep breath. Let's pull all these threads together. Think of this last section as your cheat sheet for exam day, connecting everything back to that one big idea. This table right here is your golden ticket. Let's run through it. Stock issuance, valued at the cash you get. Non-cash issuance, fair value. Treasury stock, the cost you paid to buy it back. And stock dividends, it's all about size. Fair market value for small, par value for large. Seriously, pause right now and take a screenshot of this. It's the perfect summary of all the valuation rules we just talked about.
So, let's bring it home with our golden rule one last time. Because if you get this, you get equity. All of these transactions we've discussed, issuing stock, buying it back, paying dividends, they are all capital transactions. They live and die entirely within the equity section of the balance sheet. I'll say it again. Nothing, and I mean nothing, hits the income statement.
And I want to leave you with a final thought, something to connect these accounting rules back to the real world of business strategy. If a company can't record a profit from buying back its own stock, why on earth do companies spend billions and billions of dollars doing it? What's the real strategic play there? Thinking about questions like that is what will take your understanding to the next level. You're doing great work, keep it up, and I'll see you in the next explainer.